As we head into a new year, one of the things to watch out for would be India's economic growth. The trajectory is northward, but the challenges are also persistent. So how does 2026 look for India? India's central bank has released an assessment, that's the RBI or the Reserve Bank of India. It has released its latest State of the Economy report and it offers some valuable insights. We'll start with the big numbers. The growth rate remains strong. The RBI has highlighted the latest GDP numbers from July to September. India grew at 8.2%, which is the fastest pace of growth in 6 quarters. India remains among the world's fastest growing major economies. What's more encouraging is the fact that this growth is not driven by exports or government spending. The growth is not driven by exports or government spending. India's growth is driven by its people who are spending more and its businesses that are ramping up investments. In other words, private consumption is a key growth driver, especially in rural India. The RBI report discusses some trends. In November, key indicators showed strong momentum. More goods moved on Indian roads, consumers used more fuel, and digital payments picked up. Car sales are also climbing. Showrooms are reporting their strongest sales in more than a year, and there are two main reasons for this. First is the tax cuts. This year, the government reduced GST on most consumer goods. GST is the goods and services tax. It is India's main consumption tax. Earlier this year, the government cut this tax across the board, and the auto sector was a big beneficiary of GST cuts. Cars became more affordable, so the sales climbed. The second reason for increased auto sales is festive buying. The wedding season and the holiday demand boosted purchases, but this trend is not limited to automobiles. Overall, consumption is driving growth across sectors. And that's the assessment of the RBI. So the momentum is not a spike, it is sustained and it's a sign of resilience. But will this momentum carry into 2026? There's a high chance it will. Let's look at what's working for the Indian economy. Inflation is low. It has fallen below 1%. This is according to the latest data from November, less than 1% inflation. Other indicators are holding steady too. Foreign remittances remain strong. So do India's services exports. Plus, the current account deficit has narrowed. Now, what is a current account deficit? Think of it as a country's balance sheet, a balance sheet with the world. It tracks how much India earns from abroad and how much it spends. When spending is higher than earning, there is a deficit. Now, India has been running a deficit for a while, but in the month of November, this deficit narrowed. It fell to $12.3 billion. All these positive indicators led to an interest rate cut. The RBI lowered rates a few weeks ago. It's a sign that the central bank wants to support growth by encouraging businesses to expand. You see, a rate cut is an effective tool for that. It makes loans cheaper for everyone. It pushes more money into the economy and it encourages borrowing. The RBI believes that this will help India maintain its growth rate. It has also upgraded its growth forecast for the current financial year. The Reserve Bank says India will grow at 7.3%. The earlier projection was 6.8%. That's a significant jump to 7.3%.